Okay, we're back. This is Josh Jelinski, the financial quarterback, coming to you live with Dr. Lacy Hunt with any of your questions. So, Dr. Hunt, so all this sounds very bad for the economy. What is an investor to do?
Well, basically, what we're continuing to do is we try to solve an indebtedness problem by taking on more debt. The economy's long-run performance continues to deteriorate. There's basically no way out of it. So you just grind lower and lower and lower. The risk is that down the road, there will become a general awareness that the debt only provides this very short-lived boost. And then, and we look back over history, we find cases where governments take rather extraordinary and what are foolhardy measures. For example, Germany was very indebted after the end of World War I, and to try to pay their debts, they made the liabilities of the German central bank legal tender, medium of exchange. And then, of course, it generated very rapid inflation and completely destabilized the situation. The same thing happened to Chiang Kai-shek's China in 1935. It's happening in a couple of countries in Latin America today. And so the risk is that you go to what is outright money printing. Not today. The Fed's liabilities today are not money. They have a transitory boost on the money supply. But if we made the Fed's liabilities medium of exchange and the store of value, then you would trigger Gresham's law. And the bad money would chase out the good money, would go into rampant inflation, and everyone would then become truly miserable.
Isn't that, what's the likelihood of that happening?
Well, I don't know. It's hard to say. When the Federal Reserve was set up in 1937, after we exited the gold standard, the Fed was set up to be the lender of last resort. The writer of the Federal Reserve Act, Senator Glass of Virginia, did not want the central bank of the United States to become a banana republic. And so the Fed was given great lending powers, but not spending powers. Now, today, we have proposals that are on the table that would create a virtual account for most adults, and then we would fund it with the Fed's liabilities. That would be the equivalent of true money print, which is what Germany and China and many others have done. And you would go into rampant inflation, and it would be very difficult to operate, very difficult to operate. The current Fed chairman holds his job until the end of January of next year. He said that he is committed to the Fed's lender of last resort, not spender of last resort. And so I don't think it would happen in the next year, but a new chairman of the Federal Reserve might go in a different direction. Now, to do that, the Federal Reserve Acts would have to be rewritten. And that would be a process that everybody would have some say in it. But it would be just hard to see how it would unfold. But
nobody has say in anything.
Advocating that we go in that direction. But in my opinion, it would be taking us from the frying pan into the fire.
But it looks like that's the only way out of this. They're going to give everybody, universal basic income if you have a certain income below a certain threshold at the next point of crisis, whenever that is, 12 to 18 months, 2 years, whenever this runs out, the sugar high that we're experiencing in the economy. I don't really see any way out other than that. I guess that's why Bitcoin is rising. Although if we have deflation, Bitcoin will be falling. What do you make of the rise in Bitcoin relative to all of this?
Well, one of the critical relationships that the GDP, or total nominal spending, is determined by both the amount of money in circulation and the velocity of money, or the speed at which it turns over. This is called the equation of exchange. It was originated by Irving Fisher. And Fisher said that when economies become extremely over-indebted, such as we are, the velocity of money falls. And in fact, the velocity of money in 2020 hit a new all-time low. We have data back 120 years, just as Fisher said. So the Federal Reserve came in, they engineered a very large increase in the money supply. In terms of the GDP, it was neutralized by a fall in velocity. So when the Fed increases the money supply in the 20% range, which they did last year, but the velocity of money falls, the money is basically trapped in the financial markets. And so there's plenty of liquidity to bid up financial assets and assets that are financed by a lot of leverage, such as housing. However, that money does not make it into the real economy. And there is actual corroborating research from some pretty serious economists. For example, the Nobel laureate Michael Spence has pointed out that when the Federal Reserve engages in these asset purchases, and when they come in to support the value of financial assets, it gives a signal to the corporate managers that the financial assets are protected. So in a crisis, you can always sell your financial assets, and their value will be relatively secure because you can count on the central bank. However, real assets are not protected. And so the corporate managers are shifting more and more of their resources into financial investments. That's why the prices of so many of these assets are quite high. However, financial assets don't grow the economy. You need investment in plant and equipment, real assets. And so the policy result shifts more and more assets into the financial economy and less into the real economy, which undermines our capacity to grow, which tells us the same thing that's happening to the velocity of money.
Yeah, in essence, really that's a great point, because in Bitcoin there is no velocity. So
Bitcoin is
the absence of velocity.
That there is excess liquidity in the financial market. I mean, Bitcoin does not have a stream of future earnings, such as a stock or a bond. So there's no way to calculate net present value. It's not a store of value like gold or silver or platinum. So to my way of thinking, it's another barometer of the fact that when you have large increases in the money supply and a shift of resources into financial assets away from real assets, all of those assets are going to be bid up. It's a barometer of excess liquidity. And that's the best explanation that I can give you.
Yeah, I mean, technically, it looks like Bitcoin's going to hit 100,000. So what do you make of that?
As long as the liquidity continues to pile up, then it's going to go into the financial assets. But the presumption that it will make it into the real economy, other than for a transitory period, is, in my view, not correct.
So what do you do with your money? I mean, I know you're a big fan of U.S. Treasuries. You're still long Treasuries. When do you see rates start going up?
Well, I just told you earlier that inflation is a long lagging indicator. The gap between when you have a start of a recession and the low point in inflation is about 4 years. Well, the recession started in February of 2020, which means the inflation rate ultimately, although it's going up right now, is going to tread lower in 2023, 2024. there is a presumption that because we have rapid increase in the money supply and the Fed is buying $120 billion of government and agency securities every month, that this is stimulative. However, there are other stools there are other legs of the monetary policy stool, and they're not working. One I've mentioned, the velocity of money is falling. Another stool of monetary policy is the policy rate, the federal funds rate. And historically, the policy rate has been a major tool. In economics, prices are a very powerful variable. Prices are what cause people to change incentives. And the policy rate is stuck at zero. The Federal Reserve says that they're opposed to negative interest rates. And so consequently, the price mechanism is not working. But historically, from the start of the recession to the low point in the policy rates, you're talking years, 6, 7 years in some cases. And so that the policy rate or the price mechanism is no longer there. The final stool of monetary policy are the banks. Now, the banks have unprecedented amounts of reserves. And many people who took one course in economics would say, well, if they've got the reserves, the bank will lend them. However, that's not happening. And I don't believe it's going to happen because the banks can have reserves, but to lend them, the bank has to cover all of its costs, including the risk premium, which is the possibility that the borrower will default. And the borrower must pay the risk premium. And so the risk premium in this environment, in spite of the recovery in the economy, is going up. And the net result is that bank loans are falling. So of the four stools of monetary policy, you have the quantitative effects, the first round increase in money supply, that's working. But the velocity of money is falling. The policy rate is out of commission. And the banks in the current environment cannot price through the risk premium. And the net result is monetary policy is not nearly, and it's not powerful. It's basically emaciated. And that's exactly what happens when economies become extremely over-indebted.
So we're going to be like Japan for the next 20 years?
We're proceeding on the same path. And by the way, it's not just Japan that is proceeding on this course, it's Europe too. Since 1989, Japan has adopted maybe 30, 35 debt finance programs. Europe, not quite that many. And by the way, when your economic growth rate comes down, there's also a collinear deterioration in demographics. The population growth slows, the birth rate falls, family formation rate falls. The growth in U.S. population last year was the slowest since 1918, which was the pandemic year as well.
Well, we may have the highest, though.
Historically, our population has grown about 1.2% per annum. Last year it was 0.25.
Well, let's take a short break. We'll talk about that when we return with Dr. Lacy Hunt, and I'll ask him, what about all these COVID babies? Could that stimulate the economy? When we return, this is Josh Jelinski, the financial quarterback. Don't touch that dial.
The preceding program was sponsored by the Jelinski Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and Top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jelinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Wealth Quarterback website at www.jelinsky.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jelinsky and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation.
Advisory services offered through Wealth Quarterback LLC.